So today I'm teaching Lending 101, and I mean, these are small groups. We keep it pretty casual. So we'll definitely do some Q&A stuff. So if anything hits your mind while I'm going through the slides, just raise your hand and we can talk about it for more info. So there's quite a few slides, but I'm going to go through it pretty quickly. So the people that you refer to your clients is very important, right? Because your reputation is at risk, you could say, or the transaction could be at risk, right? We had a couple of stories this morning about lenders not performing or not being communicating. So I'm here to not do that, to help people, give them good advice, be a counterpart for you, and to help us both succeed. So they will ask you lending questions, and I did a little video yesterday. I don't expect you guys to be an expert. I don't think any clients expect you to be an expert in lending, but this is going to help just kind of go through some high-level stuff so that you can field those questions if you're doing an open house or talking to people, right? It's super important. So understanding the process of a home loan, if you haven't gone through that before, and if you have, we'll just recap it. And then the idea is to, through the knowledge in those conversations, to convert leads and clients to be actual buyers. So overcoming common objections. I have poor credit. We hear that a lot, right? I don't make enough money, or I don't know if I can buy a house, right? A lot of the conversations start that way of like, well, I don't even know what it takes, how much I have to make, etc. And then I don't have 20% for the down payment. So that's still a common myth that's out there. A lot of people think that you need 20% down, which is crazy to me because I'm hoping that people are getting more educated, you know, especially with social media, you know, people advertising down payment assistance and stuff like that. So these slides will help us overcome some of those objections. So does anyone know what DTI is? Debt to income ratio. Cool. So this is a simple calculation of how to calculate that. So if somebody earns $120,000 a year, that's $10,000 a month, and we're going off the grossly month income, so before insurance deductions, tax deductions, and everything like that. So for round numbers, we use $10,000 a month. PITI, which is principal, interest, taxes, and insurance. So that's not the whole mortgage payment, that's just the principal and interest portion. In this example, that's $2,000 a month. So your front end ratio, which is just income to PITI, is 20%. Okay? Now there's a second ratio, which is called the back end ratio, and the back end ratio includes all their other debts. So car payments, student loans, credit cards, things like that. So in this example, the client has a car payment of $250, credit card payments of $250, and this is minimum credit card payments. So if somebody owes $10,000 on a credit card, the minimum payment might be $150. So that's what we use. We just use the minimum payment that shows up on their credit report. So child support of $500 a month. So their debt ratio is $2,000 for PITI and then $3,000 for PITI plus all their other debts. So their DTIs would be 20% front end and 30% back end. Okay. Down at the bottom, we can see that the max DTI for conventional is 50%, and that's the back end ratio. FHA, you can go up to 56.99%. So a lot of times when I'm talking to people and they're trying to qualify for as much as they can, even though they have a credit score that might get them a conventional loan, an FHA loan will flip to that sometimes, and this is why. Because it'll let them go higher on their buying power because of the debt to income.
So quick question.
Yeah.
So when you say 50%, is that because it's the back end plus the front end, or is that just the back end? That's the most important.
So down at the bottom, those are separate from the examples.
Okay.
Yes, but the back end ratio is the most important.
Okay.
And so these are just the back end ratio limits.
Got it.
So in this example, the person's back end DTI is 30%, so they could go up higher. You can go all the way up to 50.
Okay, and what is the benefit, if a person does have good credit,
Mhm.
but but a higher DTI to use an FHA versus conventional? Is there like a
So,
better rate or?
so let's say somebody has a 700 credit score,
Yeah,
and on a conventional loan, let's say 3% down, a $400,000 house gives them a 50% back end ratio. But they really want a house that's 450,000.
mhm,
So even though they can get the conventional loan at 400, they can't go above 50% DTI. So if we moved it to FHA, we can go up to almost 57% on the debt to income. So they would be able to buy more house in theory with an FHA loan than they can with a conventional loan.
okay, is there
Does that make sense?
yes, is there any harm for doing an FHA in that scenario?
So
Higher rate, or you have
so
to
the
have?
downside of FHA is just the mortgage insurance.
Okay,
Depending on their down payment, the mortgage insurance could be more expensive monthly.
got
And
it.
then also, they have the upfront mortgage insurance premium,
Oh, okay, so.
which is, it's added to the loan amount. So the FHA loan is more
More
expensive.
expensive, okay,
Yep.
got it.
Yeah. So if we were in that situation, I would do a presentation with the client, explain the differences so that they understand that, and say, hey, you can get either loan. This one's going to allow you to buy 450. This one's going to allow 400, and it's going to be a less expensive loan.
Perfect.
Yep. So the only reason would be to push the DTI, really.
The upfront, some of that's refundable, right? Or possibly all of it, depending on how you refinance.
It's refundable if you do an FHA to FHA refinance. Yep. So if you do like a streamlined refinance, there's a calculation that we do, and it goes as a credit on the refi.
Okay.
Yep, that's right. Yes, sir.
If like say a home was like, you're getting a loan for like 400,000.
Yeah.
With the conventional and FHA, like what would be like, if somebody was asking what the difference in like payment would be, or like interest rate, what would kind of be, because I know the mortgage insurance.
Yeah, that's a good question, and it's really going to depend on credit score.
Okay.
Because actually, contrary to what you might believe, the interest rate on an FHA loan is going to be less than a conventional. So even though the mortgage insurance might be more expensive, the interest rate's a little bit lower. So oftentimes those payments are pretty similar with a low down payment. Unless someone's doing like 10, 15, 20% down on conventional, the payments are going to be pretty much in the same ballpark. And if they have a low credit score, that's when the mortgage insurance gets expensive on conventional loans. But with an FHA loan, regardless of your credit score, the mortgage insurance is the same.
Okay, so if like you were putting 3% down on conventional and then 3.5% for FHA.
Yep.
The payment would be pretty similar, most likely?
Yeah, depending on credit score, the FHA might be cheaper actually. Yep, because the mortgage insurance with a conventional loan with a low down payment can get really expensive. Yep. Good question. A VA loan. So VA, the way we qualify loans is based on residual income, which is a different calculation than conventional and FHA loans. So we've seen VA loans get approved with like 62% back-end ratio.
That's what I was gonna ask you about the $1 million guy, I'm like.
Yeah.
How much was
I mean,
that?
his debt to income ratio wasn't that high, honestly.
But the payment, cause there's no.
The payment was huge, yeah.
Like,
Yeah, the payment was massive on that. And then down payment assistance. So we have our Movement Boost program, we have Cal HFA, and I'll talk a little bit about Cal HFA too. Because they're giving you that money, it's a little bit of a riskier loan because the person, we can assume they don't have the money to put down. So they're, on a lot of those programs, they're gonna cap that debt to income at 45%. So when we're going through a pre-approval, and if we're working with a first-time home buyer that's in a really competitive price range, like 400,000 or less, I have to give them 2 pre-approvals. And I say, if you want to use down payment assistance, the debt to income is capped at 45, so you can only buy this amount. If you can use your own funds through gift funds from a family member or 401k money or whatever, if you don't have to use the down payment assistance, it's going to raise you up to that 57. So the difference on pre-approval amount from DPA to normal FHA can be like a lot. I mean, I've seen it be like $100,000 difference. Might be the difference between buying 400 or 500. So that's I think that's an important thing to cover, because a lot of times I'm throwing out these numbers and you'll be like, well, why is it so different? Down payment assistance is a big differentiator. Also, down payment assistance, 9 times out of 10, the interest rate on the mortgage is going to be much more expensive than normal FHA. Oop, rewound too far. Cool, so that's debt to income. Here are some acronyms and terms. So LTV is loan to value, the amount of loan compared to the value of the house. So basically the price of the house minus their down payment. PITI is principal, interest, tax, and insurance. MI is mortgage insurance. PMI is also mortgage insurance. It can be called private mortgage insurance. FICO is a Fair Isaac Corporation credit score, which is the difference between a consumer credit score. So I was talking to somebody, it was last Friday, and her son was co-signing on the loan for her, and she said, well, he thinks his credit score is like 570 because he just applied for a car, and they actually ran his credit like 15 times, the car dealership. But I explained the difference to her, and we pulled it, and he had a 611 Fair Isaac score. So he can actually go on that FHA loan and help her qualify for more, when their perception was, let's leave him out, he's not going to be able to help, okay? Because, I mean, it's an adult child, he lives in the home, it makes sense for him to help qualify. So Fair Isaac. FNMA is Fannie Mae, FHLMC is Freddie Mac, and DTI, we just talked about that, that's debt to income ratio. Housing ratio or front end is PITI by gross monthly income. Debt to ratio or back end is PITI plus monthly debts against gross monthly income.
I have a question, Ben.
Yeah.
On Fannie and Freddie, can you kind of explain the differences? Because I always...
Yep. I think it's on the next slide.
Oh.
Bam! He's using his telepathic skills.
It's all about intuition.
So who and what is Fannie Mae and Freddie Mac? So these are government-sponsored GSEs, and they were placed under conservatorship since 2008. So Freddie Mac and Fannie Mae are ultimately responsible for creating the rules around mortgages, and because they didn't do a great job of that, they're under conservatorship. The government actually bought into them as part of that bailout in 2018.
Oh, so they used to be private?
Yeah.
Wow, I didn't know
Yep.
that.
Yep. So they are still publicly traded organizations, not super valuable because the government owns them. Main purpose is to purchase loans, securitize as mortgage-backed securities, and sell to private investors on Wall Street. So when we do a mortgage loan, our company, Movement Mortgage, we have a secondary marketing section. And basically what they do is, if I do a 30-year fixed at 7% interest, our company is doing thousands of these around the country, right? So they'll take a bunch of 30-year fixed mortgages at 7%, and they'll pool them together in like groups of 5 million, 10 million, 15, 20, whatever it is. And then they securitize that group of loans, saying, we have Fannie Mae and Freddie Mac's approval on all these loans, so they fit their mold, and then they'll sell them in bulk to the secondary market. Now, I don't want to go too far down a rabbit hole, but we sell those loans, but we retain the servicing on them. So for the clients that we work with, they actually get a Movement Mortgage statement each month, and they have like a Movement Mortgage website where they can pay their mortgage. So we kind of keep them in our ecosystem, which is, I mean, there's a lot of mortgage companies moving around and going out of business over the last couple of years. That's one of the reasons I joined Movement, because that pool of mortgages that we have, that servicing portfolio, gives us much more financial stability than a mortgage company that doesn't do that. So we're actually collecting interest payments on all these loans that we've done for the last 5 years. I think they started doing it 5 years ago. And so really cool, we retain that servicing. So Fannie Mae and Freddie Mac, they provide underwriting guidelines and engines. So Fannie Mae has DU or desktop underwriter. Freddie Mac has LP or loan prospector. So when I take an application, I run a credit report, and then our system is connected with Fannie Mae and Freddie Mac, and then I push the loan to their system, and it kicks back an approval. So it still has to go through an individual underwriter, an actual person, checking all the T's and I's, but it'll give us an answer right up front. And within that answer, it tells us what the underwriter wants or what Fannie Mae and Freddie Mac want. So it'll tell us how many years of tax returns we need, how many pay stubs. If it's a high down payment with an excellent credit score, the things it asks us for is going to be less than if it's a 620 score with a high debt to income. So they have this algorithm that's built in that we input the loans to, and then it gives us an answer. If we don't get an answer or an approval through one of these, we can also do what's called a manual underwrite. And that's one of the ways that we rescue a lot of loans. Because a broker or something that's just firing out an application, they might not be as educated on that process, and so they might decline a loan that can actually be approved by manually underwriting it. Okay? Any questions on that? Was that clear enough? They're basically big companies that are responsible for verifying these loans are good and then selling them.
So my only question to that was, you said LP and DU.
Yep.
Which one does one carry more weight than the other?
That's a good question. No, not really, but their algorithms or their rules that they have built in are a little bit different.
Which one is more lenient? Or is it?
I'd say Freddie Mac is a little bit more lenient on higher debt to income files. Freddie Mac's student loan calculation lets us do 0.5% of the outstanding balance, versus DU requires us to do 1%. So it's really,
They each have their own.
yeah, typically we run it through both. So we can push a button and run it through both at the same time.
And
But
it doesn't affect the client at all?
nope,
Got it.
no.
So it's all-
They reissue the same credit report that we have, so they pull that data and pass it through. They're not pulling a new credit report each time.
Got it.
Yep, so there's subtle differences, but it's not like one's better than the other.
No.
Even the pricing, like when we're looking at the interest rate for a conventional loan, some programs want an LP, some want a DU, but the interest rates are going to be the same.
Got it.
Yep, so it really doesn't affect the client. It's just a matter of how we want to structure the file. And then also, like if I run a file through both and Fannie Mae is only asking for one pay stub, but Freddie Mac wants 30 days or 60 days worth of pay stubs, I'll go with the path of least resistance, right? To make it easier on the client. Because I've had loans where it's like, give me 1 year of tax returns for a self-employed person and like a P&L and we're good to go. And they're like, well, this other person's asking me for like 2 years of taxes and all this other stuff. So if you're not paying attention to those findings, somebody just might ask you for a generic list of stuff, which might be more than what they need. Okay?
I know you had a question. Oh, you had some question.
Yeah.
So like, is there a way we can, like when the Fed changes the rates or do anything, the whole world listens, but like for Freddie and Fannie, like when they change their guidelines,
Yeah.
do they do it often, or is there any way we can?
They actually do. Yeah, they actually do come out with updates ever so often. They're not really big updates a lot of times. Like they don't do a full overhaul, but they'll just kind of tweak things. So I'd have to pull up the underwriting bulletin, but our underwriting department sends us those bulletins as changes are made. So if it's something that's significant, I usually do like a bomb email and I'll push that out as an update to let you guys know what's going on. So Freddie Mac just did one this year regarding ADUs, to where you can actually use rental income on an ADU for the person that's buying the house. So if I want to buy a house that has an ADU, but maybe I don't qualify for that price, we can do an appraisal and they'll give us some credit for that future rental income. So as things change, like ADUs are getting more popular. So as the market changes, they do kind of adjust along with that,
Okay.
So.
Did you have a question?
Oh,
Do you have one,
I
Jordan?
was gonna say, I've been trying to learn more about like how bank statement mortgages kind of work. Is
Hmm.
this kind of like, is it similar kind of process to like just, with going through Fannie Mac and Freddie Mae, like with any kind
It's,
of request?
yeah, it's more of a manual underwrite. So those loans are non-QM loans. And there's a slide, it doesn't really go into detail, but I'll just address it right now. So bank statement loans, generally, instead of asking for pay stubs and tax returns, they're going to use your monthly income that goes into your bank account as your income in lieu of pay stubs and tax returns. So like for a self-employed person that has a lot of write-offs, it might be good for that. So instead of saying, send me 2 years of tax returns and a profit and loss statement, I'm going to ask the client for either 12 months or 24 months of bank statements for one account. And then we add up all the deposits and then we divide that by 12 or 24, and that gives us the income number. So the interest rate on those loans is going to be much higher. And also, you usually need 20% down. I think there's some that'll do 15% down, but the loans themselves are really expensive. So they kind of follow Fannie Mae and Freddie Mac as far as rates go. You can stop this thing from locking. But because it's not a securitized mortgage, there's a lot more risk to it. And so the people that they sell those loans to, they're usually hedge funds and other people on Wall Street. Those people, because it's higher risk, in order to buy them, they're going to charge more money. So a good rule of thumb is that a non-QM loan, like a DSCR loan or a bank statement loan, is going to be 2% higher than the Fannie Mae, Freddie Mac market rate. So we're at 7% right now. If you did a bank statement loan, it's going to be at least 9%.
Oh, wow.
Yeah, so you can see how that can get really expensive really quickly.
Yeah.
Yep.
Do they like not look at your, like your DTI and stuff when you do that, or?
They do look at DTI, but they're going off your cash flow, not your tax returns.
Okay.
So if there's an attorney that, let's say they collect 20 grand a month in billing, but on their tax returns, they have a bunch of write-offs and they're only claiming 10,000 a month. Doing a bank statement loan is going to let them go higher because it shows more income.
Yes, pre-tax, kind of like a gross, right? Like a.
It's gross, but on the normal loan, we have to use your taxable
Right,
gross,
right.
what you file on your tax returns, whereas maybe you're actually collecting 20 grand a month, but you're only claiming 10, right? Because as a business owner, you have a lot of flexibility there.
But you don't do that with W-2s, right? W-2s get the gross regardless of
Yep.
after taxes?
Yeah. So a W-2 employee isn't going to have many tax write-offs,
Right.
but yeah, those are really designed for like self-employed people.
I got one more question on the Fannie and Freddie.
Yeah.
Does that determine what kind of loan product you can use, whether it's conventional or?
They're both looped into conventional,
Okay,
but on FHA loans, we run DU always.
got it.
Yep. So Fannie Mae or the Federal Housing Administration, they want a DU approval or a manual underwrite.
Got it.
Yeah, that's a good question though. But LP and DU can both be conventional.
Okay.
So this is our process. So pre-qualification, typically I'll get an introduction to a client. We'll schedule a time to do the loan application interview. I like to call it a discovery call to find out what the person's goals are and just kind of ask them some questions about how much they're paying in rent, things like that. From there, we have an online application that can be done in a couple minutes. So I send that link out, or I'll take the application over the phone and just fill it out on my side. And then based off that, we can collect pertinent documentation. So when they fill out our application, depending on what they put in there, it sends them a list of what we need, like depending on if they're self-employed or W-2, et cetera. Once we have the application, within that we get permission to run a credit report. And also, we have the ability to run a soft credit pull now. We just got this a couple months ago. So if you have someone and they're like, well, we're just looking, we don't want to pull our credit, I hear that all the time, and I get it.